right. Good morning. Let me start on this page. It's Tuesday, April 7th. It's about 7 o'clock in the morning, New York time. Let's first start with what's going on. The big elephant in the room, which is the virus. And we see there's 368 cases in America, 75,000 deaths. I think it's, what, 2,000 deaths since yesterday. I've checked it like 5 times yesterday, so I can't remember exactly what it was yesterday morning. But it is getting worse. It's not getting better. They are saying it's slowing down in certain places, and so that is sparking a new interest into the stock market, which we'll look at in just a minute. But then, as you kind of look down here, more countries and regions are getting it, not less, right? So a few days ago it was 177, so that's 7 more countries that are getting it. Plus, your India is starting to ramp up a little bit. People are those numbers are going to start coming in pretty soon. As we see, we're still only talking about first world countries for the most part. First world, first world, first world, first world, first world, first world. Iran, China, if you've noticed, their numbers keep staying pretty consistent. They're not moving at all. But you can be your own judge on whether those numbers are true or not. All right. So the update for Japan, they declared a state of emergency with near $1 trillion in stimulus, and they basically said that this could be the straw that broke the camel's back. This is just the best headlining, but I read a couple different ones. The postponement of the Olympic Games, and the economy has been falling since 2008. And so if you even look right here, they're willing to put 20% of economic output into the market, right? So they're putting all stops out. There's nothing else that they can do. If Japan doesn't survive after this, then they're cratering. Because in the article, he also said, Prime Minister Shinzo Abe, he also said that Japan needs to focus more on stopping a recession and stopping a complete disaster, opposed to just thinking about the coronavirus. Because all the money into the coronavirus, yes, it might stop the virus, but the other elephant in the room is going to destroy the economy, a much fragile economy that he does not feel that Japan will be able to survive. In even bigger news, if you remember, probably about 2 weeks ago now, give or take, Boris Johnson, the Prime Minister of the United Kingdom, said he had got the virus, but he was going to self-quarantine, but symptoms got worse and worse, and so they took him to the hospital, but when in the hospital, they continued to get worse. So Boris Johnson remains in intensive care. They're trying their best to keep him alive. So let's just kind of use common sense here. If this is Boris Johnson, the Prime Minister of England, that means he has the best medical supplies in the world, right? So if it can't save him, then really the medicine isn't either going to die or not going to die. I hate to be like that grim, but here's Boris Johnson. He's the Prime Minister of the United Kingdom. That means that even if no other person in the hospital had a ventilator, he's going to get one. So if they can't save him, then we need to really self-analyze and really look at this virus and maybe adjust our portfolios, adjust our futures accordingly. The other big elephant in the room is the Russia-Saudi dance, right? So what seems like years ago now, but it was only about a week, 2 weeks ago, Russia and Saudi Arabia were supposed to come back onto the table and tell the whole world that they're going to destroy their own economies and stop producing oil. Well, they did not do that. They said the complete inverse, and they said we're going to pump and pump and pump and pump, right? So completely deflating the price of oil. We touched below 19, and then now we're kind of taking off. Oh, Trump is doing his best uh, to try to curtail that. We all know that most of our oil in America is their break even point is oil in the mid 40s, like early 40, 41, 42, 43. So if oil were to stay down, I mean, if it stays down in the 35s, these big companies can get loans, right? It's okay that they'll be able to survive it. But if oil were to stay down where it is in the 20s, and then if it were to have another leg down into the teens, right? Where I'm kind of looking, if you look at the chart, let me see. Let's go over to charts. Let's see how long they take us. All right. Well, they only let us. I don't. For on this, they don't let me do the rolling. Right. They don't let me do the rolling. Which what the rolling would show is it would show you more years. Right. This is only showing me this one for this particular contract of May 2020. Now, if you do have like not E-Trade, Thinkorswim, and you look back 20 years, all oil is it's at the same little spot that it was, give or take. I can't show you, so don't quote me per like dollar point, right? But it's around the same place that we were before the big China boom, right? I know a lot of us don't remember this. This is like the 2000s and things. I was nowhere near thinking about finance or anything. I was still in school. Um, but if you look back, oil before because we forget, China was kind of closed and all that kind of stuff, but China opened up its economy, which created the largest bull rush in oil, right? Because China was expanding, it was growing and growing and growing and growing and growing, right? So after China now is not growing, oil is going back to around the prices it was before that China boom, right? If you look, the 20 handle was very important, but even more important is the $9 handle. I can't show it right now, it's just frustrating. But maybe on a different video, I'll show you the $9. Well, it's 9 and then it's 3. I'm not really sure we'll go down to $3, but if we want to remember, it wasn't very long ago. It was in my lifetime. I'm only 36. That oil was $3 a barrel, right? We all tend to forget that, and we only want to remember when it was at 150. It was only went on the rush up during the China boom. So we have to remember that. All right, let's go to the ESs. SP 500. Now, what's interesting, let's put a Fibonacci in here so we can kind of see where are we in what happened. Where are we in relation? Here's the bottom that we hit on the 23rd of March. Here's the top on February 20th, right? Let's see where we are. So right here, we're still, we're not out of the legs yet. So if it stopped right here, which if you do some research on your own Fibonacci numbers, if nothing I'm saying makes any sense. If you stopped right here and we returned down, then that's like, and we broke these numbers right here, then it's the highest, like it's like an 88% chance. Right here is a 50% chance, and then this is like a 33% chance, whatever. So if we break here, there's a 50% chance that we could go higher, or 50% chance we go lower. If we touch here, it's still a large percent chance. All right, big chance it's gonna reverse down, 50% chance, even less chance. But if it breaks this line, just beep beep, and goes up a little bit, if we were to touch this right here, the 31.21, then there's a high probability we're gonna break out, right? But let's be very careful. The 50% mark is still 27.85. So that is 50 more points from here. So be very careful if you're trading, you're getting yourself in, you're getting new positions because we're right around the Fibonacci of the beginning of the move to the very end of the move. So be very careful. If I was you, I kind of wait to see what happens at this 50%. If we blow through there, kind of wait to see what happens right here, because even though, yeah, you're losing money, but your risk to reward is much better, right? If it holds this 50, then that you know where your risk to reward is. If it breaks it, get out. If it can't break it, right, you know where to short the 50%, and if it breaks it, get out. So it gives you a better risk to reward ratio. So if you just kind of be patient, kind of see what's going on with the market, kind of see what's going on the charts, and happy trading, happy economy, happy economics.